The dollar's uncertain future, navigating market volatility amidst U.S. inflation data and trade tensions. The U.S. dollar's trajectory is a fascinating yet complex story, especially as markets eagerly await the release of crucial U.S. consumer price inflation data. This data, delayed by a prolonged government shutdown, is set to be published on Friday and could significantly impact expectations for the Federal Reserve's next policy move. Simultaneously, renewed trade tensions between Washington and Beijing have added a layer of uncertainty to global markets. Why the dollar's movement matters. The dollar's fluctuations reflect investors' unease during the information vacuum caused by the government shutdown and shifting geopolitical signals. With limited official data, traders are relying on the upcoming CPI report as a crucial indicator of the Fed's policy path. Market expectations overwhelmingly point towards the central bank cutting rates next week and again in December, indicating a global shift towards monetary easing. However, the prospect of escalating U.S.-China trade frictions poses a threat to global supply chains just as inflationary pressures are cooling in major economies. Interestingly, the muted response in safe haven assets like gold, the yen, and the Swiss franc suggests traders perceive tariff threats as strategic posturing rather than an imminent economic crisis. The Federal Reserve's dilemma. The Federal Reserve is at the center of market attention, with traders pricing in a 97% chance of a quarter-point rate cut at the October 29 meeting. The Treasury Department's delayed data releases, a consequence of political deadlock in Washington, have further complicated the Fed's decision-making. Japan, too, faces a delicate balancing act. The yen slipped to a one-week low against the dollar as markets awaited details of a major stimulus package from new Prime Minister Sonai Takaichi, who is expected to favor aggressive fiscal and monetary easing. The Bank of Japan, meeting on October 30, is unlikely to raise rates until at least December. British inflation and sterling's pressure. In Britain, stubborn inflation at 3.8% has kept sterling under pressure, intensifying speculation that the Bank of England could cut rates by year-end. Central banks across Asia and Europe are closely monitoring the situation, aware that another Fed cut could trigger ripples in global currency and bond markets. The road ahead. Friday's U.S. CPI release will significantly influence global markets in the coming weeks. A softer reading would reinforce expectations of back-to-back Fed cuts, further weakening Treasury yields and bolstering equity markets. Conversely, a strong inflation print could complicate the Fed's easing path and introduce short-term volatility in forex markets. In Japan, Prime Minister Takaichi's stimulus plan, expected to surpass last year's $92 billion package, may offer temporary support for domestic consumption but could also exert further pressure on the yen. For now, global markets seem to be in a holding pattern, caught between the stagnant flow of economic data and the unpredictable trade brinkmanship between the world's two largest economies. As markets await further developments, the dollar's future remains uncertain, leaving investors and traders alike navigating a complex and volatile landscape.